Welcome to chapter 23. You've made it. Final chapter. This chapter, there are two important topics. Flex budgets, which we talked about that in chapter 22, and also standard cost analysis or variance analysis. Those are two areas that really are stressed in this chapter, and I'm going to emphasize that in these exercises. Before we get to that, let's look at a couple of PDFs that you've probably already taken a look at here in D2L. The first half of this, I'll talk a little bit about flex budgets, but there's another PDF on that. But the second part here in the second paragraph says the second important part of this chapter is comparison of actual and standard for direct material and direct labor. Now, we're not going to worry about overhead analysis or overhead variance analysis. We're going to look at the first two, direct material and direct labor. If you get that under your belt in this class, that's you've gone a long ways toward understanding the whole variance analysis scenario. So what we have here is, and you see some stuff here looks like algebra, but it's not. AQ and SQ, AC and SC. This is actual quantity, standard quantity, actual cost, standard cost, standard cost. Any company that you work for that's in manufacturing, which we stress a lot in this Accounting 2020, you have what's called a standard quantity and a standard cost that you are going to spend or use in regard to what your standards are, what it should be, or what your budget is. And then you want to do a comparison against, well, what was the actual quantity versus the standard quantity? Did you use more? Did you use less? And then the actual cost versus standard cost is, did you pay more or pay less than what the standard says? So when you're comparing the actual cost and standard costs, there you see cost variance. That's the difference between what you pay for something. And that could be direct labor as far as your hourly wage, or it could be what you're paying for materials that you're purchasing per unit. And so the difference in your cost times your actual quantity, not standard, but your actual quantity, actual labor hours or actual units or pounds of lead, for example, is going to give you the cost variance. Then the efficiency variance, and another term for cost variance is price variance. That's what they called it in the old days, cost variance and price variance. And then you look at efficiency, another word or term for that is usage variance. And that's the difference between our actual quantity and the standard quantity times the standard cost. And so that's going to tell us what our efficiency or usage variance. Did I use more hours than I was supposed to in my producing whatever it is I'm producing, or did I use less hours? So that's efficiency, and there's the calculation there. Cost variance, right? And your efficiency variance. So you really need to make sure you print this out and understand this as you work through these exercises, as well as on the exam. You know, I'll make another comment here. Don't be concerned about plus or minus signs. And that's a good thing. So what you want to be concerned about, is it favorable with an F or is it unfavorable with a U, right? And if it's favorable, it means that it's going to increase my net income. So if I use what? If I use my actual cost is less than standard cost, that has to be favorable, right? If it's less, if my actual cost is more than standard cost, then it's unfavorable. And by the same token up here between actual quantity and standard quantity, if I use less than what the standard allows or provides, then I'm going to save money, and that's going to increase my net income. So it's all about using unfavorable U and favorable F, not pluses and minuses. All right, the second part of this chapter is, let me make sure I'm sharing this. Yeah, it looks like I am. Second part of this is flex budget. Now this may look a little scary because this is something that I've copied out of Pearson textbook, but it's not. It's called the 5-columnar flex budget variance. Now the process to go through this is obviously on the left side is how many units, right? How many units am I selling? In this case, DVDs or CDs. Sales revenue, is based on those units. Variable expenses, right? Contribution margin. We learned that a couple of chapters ago. Contribution margin format minus fixed expenses is my operating income. Why are we breaking out variable and fixed? Because the variable is going to flex up or down based on this volume. All right. So the first thing you want to put together or put in here when you're putting one of these flex budget variants together, if you're assuming all this is blank, it's going to be column 5 out here. And I can't click on that and highlight it, but column 5. That's your static or master budget. That's what you begin your year with. And so the budget was that we were going to sell 8,000 units. Our revenue was 96,000. Our variable expenses, direct material, direct labor, and the variable portion of overhead, and the variable portion of selling and administrative is 64,000. So we plan to have a $32,000 contribution margin. Minus all of my fixed expenses gives me an operating income of 12,000. But what happens if now, if we go to column 1 and our actual results, meaning after the year is over, well, the month is over. This is a 1-month analysis. After the month is over, what if we sold 10,000? I mean, that's 25% more, isn't it? 10,000 divided by 8,000. We sold 25% more than we planned. And so what would my budget have been? Because the flex budget is a what if. What if I had sold 10,000? Well, your sales revenue is going to be 25% higher, right? So 25% on top of 96,000 is 121. My variable expenses are going to be 25% higher. 86 divided by 64. And so that says my new contribution margin is 35,000. Well, look at my fixed costs, 19,000, which is a little bit less than a static budget. So the comparison is now, if my actual operating income is 16,000, I'm $4,000 more. Is that good or bad? Well, obviously it's good, but it's as good as it should have been. And so that's when we have to take this master budget and create a new budget here in column 3, the flexible budget analysis. So if I've got 10,000 divided by 8, that says I'm going to increase all of my budget categories by 25%. So 25% on top of 96 is 120,000. When I said 121, this is all actuals. There's no calculation here. This has to be given to you. And so this column here, 120,000 is 25% higher than 96. 80,000 is 25% higher than 64. 20,000 is 20,000. That doesn't change, does it? Because we're in what's called the relevant range. All right, so 20,000. So we should have had a $20,000 net income based on a new improved budget based on this volume of 10,000. But in reality, what? We had 16. So we have a $4,000 unfavorable variance to the flex. Yeah, 16 is better than 12, but it should have been a lot better. And these other column 2 and column 4 is simply comparing 3 is compared with 5, and 1 is compared with 3 to get 2 and to get 4. All right, so 10, 2,000. Anytime you have more units, that's considered favorable. The rest of these, you ask yourself, is this favorable to the bottom line or unfavorable? 120,000 is 24,000 favorable to the budget. 80,000 is unfavorable, but that's okay. It's always going to be unfavorable if you have more volume. All right. And of course, that's always going to be 0. So this says that explains why we have an $8,000 favorable, should have an $8,000 favorable variance to the budget. And this is comparing 2 budgets. I know that seems kind of strange, but comparing 2 budgets. This column 3 is the budget we should have had we had knowledge that we're going to sell 10,000 units. And in the flex analysis, which is very important, my actuals of 121, meaning that's what I actually sold, my revenue compared to 120 was 1,000 favorable. So even then we must have charged a higher price, didn't we? My variable expenses were higher for whatever reason, more than it should have been, 6,000. And so we had a 5,000 unfavorable variance, that contribution margin. And then my fixed, I was $1,000 favorable. I had $1,000 less in actual expenditures. This is cash going out the door, column 1. These are actuals. Or I guess I shouldn't say cash, expense going out the door because it's accrual basis. And so 19, I had $1,000 less in fixed costs than I had anticipated. And so then you see the flexible budget variance, you had the sales volume variance, and then the two together says we had $4,000 favorable static. And that's comparing column 1 with column 5 in total. It's $4,000 favorable. All right, so there's some more information there. You need to make sure you follow the process. And I highlighted the process for doing this 5-columnar budget. And you will see something like this on the exam, just like you'll see something like this other exercise there or layout. So make sure you understand those two screens. Having said that, let's go over here and look at the homework. All right. So here we've got banner systems. The startup company makes connectors for high-speed internet. Variable cost, $105. Fixed cost, $4,500 per month. Static budget predicted production sales. When it says static, that's the same thing as the master budget that we just looked at, that column 5. Company actually produces those 77. Total flexible budget cost for 77 connectors per month. All right, so if I got 77 units of output, the variable cost per unit is 105. All right, 77 times 105 plus $4,500 fixed tells me my total flexible budget cost is $12,585. All right, number 2. Major net systems startup company. All the information there you can read. If you're trying to set these standards, right, set direct labor standards, again, that's the actual or standard quantity, SQ. It's based on what? Continuous improvement, benchmarking, time and motion studies. You know, that's what an industrial engineer does. An industrial engineer worked for me at Exide that actually did time motion studies out on the plant. Would go out there with their clipboard and 2 stopwatches, and they would watch the process to make sure they understood how many connectors could someone make with a lot of factors built in. All right, here we got another budgeted 3 hours of direct labor per connector, standard cost of 16. I actually worked 200 hours, completing 77 connectors. All 77 connectors actually produced were sold. So what does that look like? If we have an actual cost of $16.80 and the standard cost of $16, meaning that's what we should be paying, is $16 an hour. You're actually paying $16.80 times the actual quantity, not standard quantity, actual quantity. That says my direct labor cost variance is $160. And that's unfavorable. Why is it unfavorable? You're paying more than the standard allows. You're paying a higher wage than what HR, Human Resources, said you should be paying. All right, and number 4, person probably most responsible for direct labor efficiency is who? Production manager and his or her supervisors. They're the ones that control the efficiency, not HR. HR may set the rates. Marketing has nothing to do with it, or purchasing, but production is the one that controls it. All right, let's look at practice set 1. It's a good chapter, a lot of good stuff in here. Match each term to the correct definition. Flex budget is what? Summarized budget for several levels of volume that separates variable costs from fixed. Now, you do a flex budget during the budgeting process. You may have 5 different budgets based on 5 different volumes. Very common. But you also use flex budgeting after the fact when you compare your actuals with that new flex budget. And whether you had a flex budget set or not, you can easily calculate a flex budget based on what we just saw there in that 5-columnar example there in that PDF. Flexible budget variance. Prepare for one level of sales, sales volume variance. Difference rising only because the number of units actually so differs from the static budget units. Excuse me, flexible budget variance, not number 2, it's down here number 4. The difference arises because the company actually earned more or less revenue or incurred more or less costs than expected for the actual level of output. All right. Static budget. Budget prepare for only one level of sales. Master budget, and then variance E. Difference between the actual and the budgeted amount. All right, complete this flexible budget analysis for 10,000 travel lots. All right, so they give you actual results and flex budget, don't they? So this is just a 3 column. They leave out the other part. They're just doing the flex budget part. So if we got 10,000 units, sales revenue, actual results. So again, your actual results equal your flex budget. So there's the comparison. You're just doing a variance analysis. Sales revenue is more as to the bottom line. Variable costs are more. So that's going to be negative to the bottom line, which is a U. All right. So you can see there, as you go down through here, anytime costs are more, that's unfavorable than the budget. And operating income is more, so that's favorable. Very straightforward. Number 3, again, you can read that on your own. Benchmarking, efficiency variance. Again, efficiency variance measures whether the quantity of materials or labor used to make the actual number of outputs is within the standard allowed. Every company has standards, or else you don't know what's going on in your production process. You got to know how many labor hours or machine hours. You got to know how much materials to be used, down to fractions, decimal places. Cost variance, how well the business keeps unit of cost of materials and labors within the standards. Efficiency, usage, cost, price variance. Number 4. All right, here we've got manufacturer lead crystal glasses. The standard direct materials quantity is 0.8 pounds per glass. It costs us 60 cents per pound. Actual result, 1 month's production of 7,300 glasses, 1.3 pounds per glass. So here you're going to have to do a calculation, right? Actual cost minus the standard cost times the actual quantity. Where did 94.90 come from? You got to multiply. You don't just use the 1.3 versus the 0.8. How many glasses did you make during the month? Times how many pounds per glass. So that's actual glasses, right? Times 1.3 pounds per glass, and then 0.8 pounds per glass times your actual glasses manufactured. Doesn't matter how many you plan to make, it's actual times your standard. So 94.90 and 58.40. There's my 94.90 times the difference in the 2 costs, gives me my direct material cost variance. And then if I want to do the efficiency variance, that's my quantity actual minus the standard times the standard cost. Doesn't look good, does it? 21.90, unfavorable. I used a half a pound more glass per glass, right? Half a pound's more per glass. That tells you right there it's not going to be good. I just like to tell your supervisor, I used a half a pound more glass in this product than I'm supposed to. Obviously, that's going to be unfavorable. All right, number 5. And here's one where they're using labor hours, right? Instead of, and labor costs instead of pounds or material usage. So I pay $13 an hour, and the standard says I can only pay $11 per hour. What's my actual quantity? 27.20. That's based on what? .4 direct labor hours per glass. Actual times 6,800 glasses, 2720. Actual times the difference is actual and standard. And then the bottom part, again, usage. Usage looks pretty good, doesn't it? 0.4 direct labor hours is what I used. Now I'm supposed to use a half hour. What was that, 0.4 is 60, 24. Took 24 minutes of direct labor and I was supposed to use 30 minutes. I came under 6 minutes per glass. That's good, so you know it's gonna be favorable based on standard cost. Got to be careful when you do these calculations. That's why that chart I put up there at the beginning, it's very important that you understand that. Like when you work these problems, that's the first thing you should do is make a little template. And that same template you use both for usage, for efficiency, and also for cost. Number 6. All right, this information is given. You already know what the calculations are. Maybe somebody in accounting has done this. So now it's up to you as a manager to determine, well, who's responsible for this? Direct materials cost variance. Well, they have a bill of material cost in there. Bill of material not only on what you use, but also the price. And so purchasing, supply chain are the ones actually executing the contract. So the question is, why did they pay $682 more than they were supposed to? What about efficiency? That's production. How much material and how much labor do you actually use is your production area? What about the cost variance? Well, HR is setting the labor rates based on peer reviews locally of other industry. And once that labor cost is set, that's what you should be paying. And then direct labor efficiency, again, it's back on production. So usage, right? Usage is always, or efficiency is always production. Cost is either HR for the labor or purchasing for the materials. You can read the rest of that on your own. All right, number 7. Ergo sells its main product, mouse pads, $11 each. Variable costs are $510, that's per unit. And so here we got 40, 55,000, and 70,000. So here you're just calculating each of these. 11 times 40 is 440. 11 times 55 is 605. Variable cost, 510 times 40 is 204. 510 times 55 is 2,800. And then your fixed cost, says fixed costs are 200,000 per month for volumes up to 65,000. So then once you get to 70,000, you're outside the relevant range. Remember that term? So your fixed costs are going to step up. Maybe more brick and mortar, more equipment, another shift, which requires more fixed costs for salary supervisors and the like. So that's a simple 3-step budget for 3 different volume levels. Number 8, get a little bit more complex as we go through here. There's my actuals, flex, and the static budget, fill in the blank. So if I know this is 42,000, right? And it says 6,000 favorable, so that's 6,000 more than the budget. Anytime you've got more volume, flex budget volume, that's a good thing. All right, and so 213 and 16, that's favorable, so that's got to be more. All the way down. Notice on this is always 0. Fixed, your flex fix and your actual original budget has to be 0. Same way up here, because your actual results is what drives this flex budget. So when you're putting this together, as we'll see shortly, whatever your static budget is, then you look at your actuals, and your actual volume there drives your flex budget to get a new budget. You use the budgeted cost per units over here for revenue and for variable cost per unit times that new volume. Students get mixed up on exams on that. There's some of the detail about what you should be able to answer. And finally, number 9. they give you your volume levels here, and the original static budget is based on 8,000. So all you have to do there is copy this 8,000, which is 160,000, 88,000, there you see it, 72 and 50, 22. So there's my original budget. Then it says the company sold 10,000. So there's step one, is doing this static budget column. Then you want to do the actual results. And it says they sold 10,000 units during July. And there's your 10,000 units. So you just copy and paste all of that right down here in the actuals. It's a little bit confusing the way they do this, because then the budget amounts per units over here, 20 and 11, is based on 160,000 divided by 8,000 and 88,000 divided by 8. That's where they get to 2011. So it's really, I wish they would put this budget amounts per unit over here to the right, because it applies to this static budget. So once you've got your actuals, the last step is this flex budget. So this $20 there, which is what the budget is, times 10,000 gives you 200,000. And the 11,000 times the 10,000 gives you 110,000. The 50,000 doesn't change. It's the same as the original budget. And so now you've got a new budget based on 10,000. So you see how this works? Column 5, then column 1, and then column 1, that drives column 3. And then you just compare your variances, or compare your columns to get your variances. And again, it's favorable when it adds to the bottom line or to your net income. It's unfavorable when it doesn't. All right, so that's practice set 1. Let's look at practice set 2. Only one problem here. Okay, they want you to actually put in the formula there. Get exercise. So what you're doing here is, these are boat fenders. Talking about 20,000 boat fenders using 145,000 square feet of vinyl, purchase $1.10 per square foot. Whenever you do a problem like this, you need to pull out in this problem, you need to pull out the material as one section and the labor as a separate section, because that's what you're doing here. It's like a complete problem of what you would see in business. So 145,000 square feet, $1.10 per square foot, there's your material. And then your labor is 420 hours, $12.50, a lot of stuff going on here. So that's why you need to separate into 2 sections. And then they give you the standard, 7 square feet of vinyl per fender. So 7 times what, 20,000 is 140,000 square feet versus 145. Well, let me highlight that for some reason. 7 times 20. Manufactured, that means actual. Actually manufactured 20,000 fenders. And the standard would have been 7 times that. Right? Labor standard was 0.024 direct labor per fender, which times 20,000 is what? 480 versus 420. All right, there's the solution. So there we've got $110 per square foot minus $1.15 per square foot times 145,000 square feet, because that's the actual square feet using, right? They manufacture 20,000. All right, so $1.10 minus $1.15 times the actual. There's the AC and SE and the AQ like I had in my PDF. So that's $7,250 because I spent less money on per square foot. Purchasing did a good job, didn't they? But the question is, did you have to use more of the material? Maybe it's shoddy material. If you go down, and I'm going to do that, go down to the efficiency side of it, 145,000 minus 140. See, they don't do what I just said. They don't break it out between material and labor. They do the cost variance on both. But let's do what I said there. Let's go down here and look at 145,000 square feet minus 140 times $1.15. The standard is $5,750 unfavorable because I used a lot more square footage, didn't I, than the standard allows. So if I manufacture 20,000 actual fenders and I'm supposed to use 7 square feet, that's 140,000. That's what I should have used based on the actual production at the standard. So I used 5,000 more square foot, even though I got a good price, didn't I? So 57.50 unfavorable versus 72.50 favorable, I still came out ahead if you compare those two for just material. All right, and then if we look at the cost variance for labor, I paid $12.50 an hour. I paid $1 more an hour for my labor, didn't I? Times 420 direct labor hours, that's the 0.024 times 20,000. That's where they get 420. 0.024 times 20,000. No, excuse me, sorry about that. Production required 420. So there's my 420 actual hours. Told you wrong. The standard is 0.024 times 20,000. And so 145,000 square feet, or excuse me, 420 direct labor hours times the $1 is 420 unfavorable because I paid $1 more per hour. And then the materials efficiency variance, or excuse me, direct labor efficiency variance is my 420 minus 480, was that 0.024, which probably has it on here. I guess, yeah, there it is. 0.024 times 20,000 is 480. So I had 60 hours favorable times my standard cost, standard wage, 690 favorable. So what does all that look like when we fill this out? Well, there's your direct materials cost variance and direct labor cost variance. And then your direct materials efficiency variance and direct materials efficiency variance and direct labor efficiency variance. So look what it says here by doing an analysis of this. Direct materials cost variance can amount to unfavorable direct materials efficiency variance unless the manager have used lower quality direct materials. But it did turn out favorable overall. You paid less for the material, but it took more hours. But when you combine the two together, it was favorable. What about the labor? You paid more per hour, didn't you? $1 more an hour, but what? You used less time, which is good, which probably tells you got more experienced people working for you. Good exercise there. Again, they split it out, and I guess you probably need to learn how to do it the way they've got it for the exam, but typically I would put the materials cost variance and materials efficiency variance together, and then do the labor cost variance and the labor efficiency variance together, because that's what you're comparing, not the way they've got it broken out here. I think it's more confusing. All right, and then finally here, the self-assessment. One exercise, and I'm sure this is a flex budget problem. Yes, it is. And they give you all the information for this. The static budget is 7,000 up here at the top. 7,000 units. So all we do is what? Go down here and plug in this 7,000 column all the way down. See that there? That's all you do. Start with column 5, the budget. Then it says the company sold 9,000. So our results are 9,000. And we're going to use that to copy over the 9,000 level. Sales revenues 214. There's my 104, my 110, my 52, my 58. Right? That's column 1, all that's given. Your per unit, again, is based on Column 5, 161 divided by 7 is 23. 77,000 divided by 7,000 is 11. Because we're going to use that to do our flex budget. So how do we do the flex budget? It's all driven based on these actuals. So 9,000, because that's always 0 there. Just like this is always 0 down here for fixed. So the 9,000 drives this entire column flex budget. So 9 times 23 is 207, 9 times 11 is 99. But in fact, I think they give that to you here. Yeah, they give you those numbers. You can calculate them yourself based on these per unit, but they give that to you. 207 and 99, 108 and 51. So that's given. And then you just do your variance analysis. Flex versus static. 46,000 favorable. They actually should show 2,000 there, but they don't. 46,000, that's favorable. Got more costs, that's unfavorable. But overall, my contribution margin's better. That's always 0. Your flex budget, remember, relevant range, fixed costs don't change. 24,000 favorable. That's just comparing budget to budget. That's what it should be. All right, and then I compare my actuals to the flex. That's what everybody wants to know about in your company. Got 214,000 versus 207, that's 7,000 favorable. Should be 46, but it's 7. My cost went up 5,000. They should have went up 22,000, so that's good, but again, compared to flex budget, that's unfavorable. Contribution margins 2,000 favorable. It should have been 24,000 favorable. And fixed expenses went up 1,000. It shouldn't have gone up any because you're in the relevant range. So my flex budget variance is 1,000 favorable, right? 1,000 favorable. 58,000 versus 57. And then my flex budget versus the static budget says I should have been what? A sales volume variance, I should have been 24,000 favorable. But overall, my static budget variance is 25,000. Adding those two together, 1,000 favorable on the flex and 24,000 on the volume. 25,000. And there's the analysis. Good stuff. It's a good chapter. This is real world, not just for accountants. This is stuff that your accountants may put it together. But this is stuff that managers, supervisors need to understand in running your business, because businesses are run by numbers. Of course, the key is to motivate people to do the right thing, hold them accountable. But that's what you learn as you progress in your career. All right, so that is the end of chapter 23, and enjoyed having you this semester. If you're unsure about what you're majoring in, I would encourage you to consider accounting. It is a great foundational major that it's not just for bean counters or people going to make journal entries. I've hired people that ended up as plant managers. I've seen people use accounting to go to law school. It's a fundamental business discipline that you have to understand the numbers, whether you're an accountant or not. So if you're undecided on your major, consider accounting. If you ever want to stop by and talk to me, I'd be glad to do that as the interim chair. Just send me an email. I'd be glad to help you in your career decisions and career choices. All right, you have a good day.